Hello, everyone, and happy Friday to our weekly webcast 27. This is Tom from MarketsFlow. It is the 1st of November, and we're recording this partway through Friday as we bring you this weekly performance for the week ending 1st of November 2019. I'm here with Adam. How's your day been, Adam?
I'm very well, thanks, Tom. It's the end of the week. Interesting news flow this week and interesting market.
That's right. Sounds good. So let's get started. This is the webcast 27 for MarketsFlow's portfolio performance for the week ending 1st of November. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's made available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. We're also SEC authorized. Your deposits are protected by the FSCS for up to 85,000. Go to marketsflow.com to learn more about our portfolio performances. You can download our mobile app on the App Store or download it on Google Play. You can sign up and start investing from just £10. Before we start, I'd like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. So having said that, let's cover the important subject. How did the portfolios perform this week, Adam?
Well, up to now, and as usual, I probably don't need to keep saying this every week, but we're only part of the way through Friday. But so there are a few hours to go before close. However, as we were a short while ago when I calculated, high growth is up 0.21% for this week, and that's 7.36 since the launch of accessible portfolios at the start of June. And that, if we were to hypothetically continue that performance for a whole 12-month period, that would work out at 22.07%. For growth portfolio, the equivalent periods down 0.12% this week, but up 7.28 since that early June launch. And that early June launch period translates, if we were to extrapolate it out to a year, into 21.85%. And for the ISA portfolio, up 0.01% this week, 4.5% since that start of June launch. And if you were to stretch that out to a year, that would come out at 13.5% for the year.
Great, thank you, Adam. And how has that fared compared to the markets as a whole?
Well, at the same time as I measured the portfolios, the market, meaning S&P 500 index, was up 1.21% measured from last Friday's close. Like last week, the index stayed this week within a fairly tight range between the highs and the lows, and implied volatility, as you'd expect in that environment, was pretty low.
Great. And how are the allocations looking within the portfolio? And I must add, before you answer that, that we are looking to add some allocation metrics onto the app, and probably that may be the case in the next release, if not the next release, the one after. So potentially within the next 2 weeks, clients would be able to see some sort of metrics around allocation, which would make it really cool. So Adam, how were the allocations for this week?
Well, the portfolios are fairly active this week, and at times quite highly allocated, exceeding 50% for some of the time. Almost all the activity was in stocks, just a small amount of options activity, and that reflects the fact that options just were not very fruitful for generating return this week in general, because volatility was cheap and hence premium was low. That's the general case. You can occasionally pick up an exception to that.
You're absolutely right. I mean, the volatility certainly is almost down to the lows. How are the portfolios risk managed through the week?
Well, with the equity market on aggregate moving in a narrow range, albeit upwards, it was a difficult week to have made much money through, focusing on varying exposure to the overall market. But there was fairly significant dispersion, however. So when it came to stock picking, that was a better place to hunt for performance. So that's where most of the focus was.
Okay, thank you. And what do we need to look forward to from here on over the next week or two, Adam?
Well, we've talked about earnings quite a bit the last few weeks as we've been going through that period every quarter. But with this week having passed, which is a pretty major week of earnings, we are most of the way through that season, really. So especially when you take into account the fact that large caps have been mostly quicker to report than small caps, as always. So most of the market capital has reported, certainly. As the earnings season passes by and diminishes in importance, and it's less of a focus of the news and the commentary, other things will correspondingly rise in importance, especially as we are in a situation now where it's a period of monetary easing by at least half of the world's central banks, and most importantly by the Fed. Everybody's watching that. So all the markers that the market believes are important to the Fed, GDP, inflation, the labor market, and we had on that subject a somewhat stronger than expected non-farm payrolls report today. All those things will be scrutinized as they come out, looking for the angle on whether each of these provides the policymakers with more scope to ease further or less scope to ease further. And clearly, stock markets take on the implications of how those numbers read. Meanwhile, we've had the S&P 500 making new highs this week, which is usually considered bullish if it can sustain them. I mentioned in recent weeks that those highs were being approached, but not quite made. But we burst through that high I was referring to, and I think it's the case that each day this week so far we've closed above that level.
Great. Very interesting. Thank you, Adam. So that brings us to the end of our podcast. Thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care.